So good afternoon, everyone. Welcome to Make Money While You Sleep channel and the community. Today we are going to learn how to buy stocks cheaper than market price using options. So a couple of disclaimers. This content is purely for educational purpose. It is not intended to be an investment or a financial advice. So please do your due diligence. So this is something which we covered last week as well. And I just quickly want to go through it so that somebody who is new, who they are able to appreciate and understand this. And if somebody is new, then they can also look at my previous videos and get more understanding. So option basics, the contract of option is of 100 shares. So every time we are talking about one option contract, it includes 100 shares. That has option has got an expiry date and a strike price. And just like any other trade, there is a buyer and a seller of that contract. Um, and buyer buys an option, sells that option on a premium, and that premium price is the option price what we talk about. Option work just like in insurance, as we spoke last discussed it last week. And there are two type of options, call and put. So this is option basics. I have covered that in last week, but somebody who is completely new, I think this is a good starting point. All right, so yeah, this is something which we covered last week. That whenever somebody is a buyer of a call, somebody is a seller of a call, somebody is buying a put, or somebody is selling a put, what are their what's their outlook about it? So this is a new slide, and we before I want to go and before we go and understand how to buy stocks using options, let's try to understand in the money, at the money, and out of the money uh, concept in option. And I think most of you must be knowing it already, but in a simple terms, when we talk about in the money, so in the money is called as ITM. So ITM is nothing but when a buyer of an option is making money. Simple terms, if we understand that, that will be very easy for us. Um, so for example, if a buyer of a call there is a buyer of a call and stock has gone up to $60, a buyer of a call is going to make money. So he is in the money, he is actually having money now, and he's making profit out of it. And if that stock goes below $50, then that buyer of a call will be out of the money. Similarly, in the put concept, the buyer of a put, because now the buyer of a put, the buyer is bearish about the stock, and if stock goes up, the buyer of a put is going to lose money, so he's out of the money. And if stock will go down, then buyer of a put is going to make money, hence he's in the money. So in a simple terms, in the money means when buyer is making money, uh, and if buyer is losing money, then it is out of the money. What is ATM then? That is at the money. So if stock remains at $50 on expiry date, the stock is at the money. So that's how we should look at it. Any question,
And
guys?
what happens when the stock is at the money?
Yeah, then buyer is not making money almost. Mostly buyer is losing that premium.
Okay, so buyer is at loss, means in any case, either the stock is at the price or it goes below, then buyer is losing in both
Yes,
the cases.
yes.
Okay.
Buyer generally makes money when the stock is ITM.
Okay.
Okay. So this is how we should look at this concept. And I'm trying to come with this concept because in the next step we will understand how it may changes our decision process or how it enhances our decision process. So we'll try to understand that. So this is an example which I took last week, and I just thought let me show you what is in the money in here and what is out of the money. So the first example was a call example in my slide in last week, and in scenario one, the buyer was making a profit of $6,400. So basically, this is a in the money right now in terms of option has what is a position of option or status of option, that is how in the money. In scenario two, Tesla was below $900, which is a below strike. So it was out of the money where buyer was not making anything. In fact, he was losing this premium and seller was keeping the premium. And similarly, in the put example, again, when buyer was making profit, the option was in the money. And when buyer was not making anything or he was losing this premium, even in put example, the option was out of the money. Now let's look at the strategy how we can buy stocks cheaper using options. Given that now we understand in the money, out of the money, at the money. Now let's look at the strategy how we can buy stocks. And this strategy is not really different than the passive income generation strategy. The the only difference in this particular aspect is about um, what is the strike we basically use to get a stocks on a cheaper price, and that's why I just wanted to bring this in the money and out of the money and at the money concept. All right, so let's look at this particular pointer.
Varun, after this, can I have ask question or
You can ask questions anytime.
no? No,
Or
actually, uh, I posted a message right regarding the Zoom call. Can you please elaborate so that we can understand these options?
uh,
so
Like,
Varun, if you
see,
can go back, some of us who probably were not there in the last call,
okay,
if you can at least little bit elaborate. I know that this might be a disadvantage for other people, but little bit elaborate on the previous slide,
okay,
where you actually more talking about the call and put options. That would be good.
okay, sure,
Yep, that's the slide. So at least we
okay,
have understand the basic pretty well.
okay, okay. Let me just take you through this also. So there are two type of options. One is call, another is put. Whenever somebody is buying a call, it is important that there is a buyer and a seller of a option. Okay, as I have covered in this, it's like just like it works just like an insurance. So there is a seller of an insurance and there is a buyer of an insurance. So you go and buy car insurance from some company, let's say Geico or State Farm Insurance. Similarly, uh, a buyer of an option is going to buy it from someone else, and there will be two parties involved. One is going to sell that option, another is going to buy that option, and there is going to be a premium just like an insurance. This is fine, right? This is clear, right?
Yeah, Varun, this was clear. This was
Okay.
clear. Yep.
Okay, perfect. So then there are two type of options. One is call, another is put. Buyer of a call, he is bullish about a stock. So a buyer of a call is expecting that, say, that Tesla is going to go to $1,000. So in this example, I have shown this. So call buyer is bullish on Tesla and expects the stock to go above $900 by March 19th. So he is a buyer of a call. He is very bullish about the stock. So he is going to buy Tesla option, Tesla call for 900 strike. And then similarly, given that this is a marketplace, if there is a buyer of a call, there has to be a seller of a call. So when this particular order has been placed, there has to be a seller who is selling this particular order. And that's how this transaction is going to happen on options. So this particular contract has happened between these two parties. This is buyer and this is seller. Both of them have the same strike, same expiry date. And if you see this, this is -1, which represents selling. This represents +1, which is buying. Okay. And this is a premium price. Just like in insurance, you have a premium of car insurance. Similarly, this is a premium buyer is paying and seller is collecting. And then I have covered various scenarios. If Tesla is going to go above $900, let's say it goes to $1,000, then buyer is going to make some profit, which will be $1,000 minus $900, which is a strike, minus $36, which is the premium, hence $64 per share. And given that every option contract has got 100 shares, so he is going to make $6,400 if Tesla goes up by $100. And given that buyer has made some money, seller is going to lose that money, $6,400.
Yeah,
But if
Varun, 1 second. Like seller loses 6,400
Mhm.
plus premium, right? Uh, he
No,
in the
just like in insurance world, if let's say car insurance company, as a buyer of an insurance, we are always going to pay the premium, right?
yeah.
So car insurance company will keep that premium. Only thing, when car will go into some problem, or there is has some accident which happens, car company is going to pay for that particular accident or issue. So
Yeah.
premium is always for with the seller.
Okay.
And
So total profit is seller. The total loss is kind of lesser than that. Okay.
yes, actually, yeah, you are right. So seller loses $6,400, but that premium is for them to keep.
Yeah. Okay.
And one more thing which I covered was, whenever a seller and a buyer they are always thinking in a different perspective, right? So if buyer of a call is bullish, then a seller of a call has to go bearish. In terms of insurance industry, you think it this way, that if as a car insurance buyer, I have given my risk of that car getting into an accident to a insurance company, right? So my insurance company is more worried about that I should not have an accident. And in this perspective, if you see, I'm not worried about my car getting in an accident because I have already paid that particular risk to my insurance company, paid for that insurance risk to an insurance company. So they are thinking in a different manner altogether. So that's how you can see that if a buyer of an option is bullish, then a seller of a option should be bearish, and vice versa. And you can also think it in some other way. If I'll give you an example, let's say if you are betting on a cricket game, right? And India and Pakistan are playing, and let's say you are bet with your friend that okay, India is going to make 300, and then I'm going to pay you $100. And so your friend is always thinking in an opposite way, right? That okay, he should not win this particular bet so that I win. So as if in any bet there will be always be two perspective, one is going to win and another one is going to lose. Hence there will be a bullish and bearishness even in this bet. So buyer of a call and seller of a call, they are betting on a same particular contract. So
So, one
similarly,
quick question in this case: do you actually need to have an exactly the same nature of the call in this case from the buyers and the sellers perspective? Because the example of Tesla, you said that we wanted to buy basically one contract of the 100 share for the price of $900, right? Thinking about that it would hit actually $900 in future. So there has to be a exact similar nature of a seller in the market for that transaction to take place.
yes.
Okay, so if the figure basically is, let's say 890 or 910, then you don't actually have that match and that particular contract will not be executed.
No, there are buyers and seller on each and every strike price.
Right. Oh, okay. Okay.
So there are millions of users who are on the terminal and they are doing this trading, right?
Gotcha.
So depending
Gotcha.
on what kind of trading they want to get into, they will place that kind of bet.
So basically chances of not having the strike price match is quite less in this
Ap-
case.
Yeah, so that's where liquidity comes into place. I mean, if you would have heard of like the term called liquidity, right? Volumes and liquidity. Liquidity is nothing but there are not enough buyers and sellers in the market for a particular
Mm-hmm.
stock, and that
Mm-hmm.
is what nothing called as liquidity. So it is possible that that a user, I mean, a buyer is not going to find a seller. Let's say you have put a order for Tesla. Let's say you have placed this particular order, right?
Mm-hmm. Mm-hmm.
But if you don't have a seller, your order will not be filled.
Not be executed. Okay.
Yes. So it is
Got
possible.
Okay.
But if
So
you
it
ever have,
has to match exactly at the same price. If not, then it won't be executed. And then you have a choice to make another call actually whether you want to go up or down.
oh yes, absolutely. And I covered this also last time. That's called bid and ask spread. So bid and ask, when that bid and ask meet together, right? Then a contract happens, then a trade will happen. And then there is a call at bid and ask spread. If it is very wide, then basically the buyer is expecting some price and seller is expecting some other price, and they are not meeting to a common ground. So that happens. That's very common.
Understand that.
And
Understand that.
and one more example, like everybody has been hearing news of GME. So in GME, what has happened? The hedge fund is basically a seller of a call. They used to sell calls, and they have these bots available, or they have these programs who used to sell calls. So this was nothing but this particular example over here. So imagine this is GME, and those hedge funds were selling these calls, and they were selling those calls which they had a probability that 99.9% they are going to win. So imagine somebody is buying a call of GME or of strike $100 like 2 months back. So they were selling it, and then it is very common. I mean, all these hedge funds, they generally sell all those kind of options where they have like 99.9% of probability. I mean, they've got billions of dollars, so they can do all that. So they were selling all those GME options So imagine they were selling GME options of $100, and Wall Street Bets was buying those options for 100 strike, and GME at that time was of around $12 or $15, and they were buying calls of $100 strike, and these hedge funds were selling that. That's why they have got so much of a loss. So all I'm saying is, but yes, there will be a buyer or a seller, and there are these hedge fund market makers who have also put their own bets for very high winning ratios. Okay, so similarly in buying a put and selling a put, uh, buyer of a put is bearish and seller of a put is bullish. So, and if we come here, and let's say if a buyer of a put is bearish on Tesla and he or she expects the stock to go below 300, so they are going to place this particular trade as a buyer. Hence, there has to be a seller who is also betting on the same trade. And there is a similar calculation here where Tesla goes to $250 on March 19, so it goes below 300. Then buyer is going to make some profit and seller is going to lose on this trade. So yeah, and in this particular example, now I added this in the money and out of the money. So in the money means
Hello.
buyer is going to make some profit, and out of the money means buyer is going to not make money. So is this all right, guys, or do we
Yeah,
want to?
Varun, I have one question on this selling the put.
Yes.
So I sold the put at 300, and if it remains at 300, I will get that premium, right?
If it goes to 300 as a
If it means at the ATM, at the money.
Mhm.
So I sold 300 put.
Yes,
Suppose it $10. I
Yes.
sold it to $10. Expiration date is March 19th.
yes.
So I got $1,000 premium.
Mhm.
So if the stock remains at 300 on the closing day, I will keep those 1,000, right?
Yes.
So if it in between, like before March 19th, can I close the deal?
Yes.
So then how it works? Like, can I get $1,000 or less than that?
You will get lesser than that. You are a
Okay.
seller of a put, right?
Correct.
Yes, yes. See, the whole premium you will get only when you will let it expire and you are in a winning position.
Oh, we can close at any time.
Oh,
Okay.
yes.
So then we can buy the put, right?
Yes.
Oh, okay,
You can
okay.
see, you can buy yeah, you have to close it, you have to buy the put.
Okay. So if it goes down below 300, like 280 per se,
Yes.
so then what will happen
Yeah.
on
So
March 19th?
yeah, if let's say this will be this a particular example. Let's say if Tesla goes to $250,
Correct.
which is below $300, right?
Correct.
Then buyer is making money and seller is losing money here.
So I don't want to lose the money. Can I buy the stock at 250?
See, that particular stock, and I think you have asked this question also on Discord. You don't need to explicitly buy the stock. These
So it
stocks will
will
be assigned to
automatically
you.
assign.
If
Oh,
you don't
okay,
do
okay.
anything, stocks will be assigned to you.
Okay. So if I buy the put, it will clear off. Otherwise, the stock will be assigned to us.
Yes, stock will be assigned to you. And if you don't have enough capital in your account, then you will get a margin call.
Oh, okay.
So you have to ensure that you have enough capital. Otherwise, they are going to mess up your account.
So what price they will give, like 250? I have $1,000 premium, right?
Strike multiply by 100.
Like 250,000, 25,000.
No, they are
If I
going to
want,
assign you for 300 multiply by 100. The strike you have selected was $300, right?
correct, 30,000.
Yes.
Oh, 30,000. And what about the premium which I collected?
That you will keep.
Oh, okay. So 290. I got it for 290.
Yes, that will be your break-even price. Yes.
Otherwise, I have to make the loss like 300 minus 250, 5,000.
Yes.
Right?
Yes.
Okay. Okay. Thank you.
So that basically Varun is as a seller in this case, right? What Keshav was asking.
Yes, that
Yeah,
is
put
like a seller.
sell of put. Yeah, selling put.
Yeah.
And at what you're saying basically, and just pardon me my naiveness here, but what we are saying actually that till the time basically this is executed, there is no holding of those shares with the seller. And now at the time basically that contract is expiring, he has two options. Either he actually take the physical possession of those shares or basically he executes the contract.
Yes, either he closes the contract. As a
Mhm.
seller or as a buyer, you always have an option to close the contract. So you can close the contract, and depending on that particular day, what is the position of your option, right?
Mhm.
Whether you are losing in that bet or you are gaining in that bet, you're going to make money or lose money, uh, some fraction of that money, whatever the premium is.
And you have that option of closing the contract any given point of time. So take an example. Let's say Tesla goes down to $20, let's say on March 10th,
Mhm.
right? In that scenario, as a buyer of a put, you are actually making much more profit.
Yes,
So in that case, you still have an option to close that contract.
yes, you can close
Okay,
it, and
you
you
can,
will you can make profit out of it as a
but
buyer.
then in that case, you have to put more premium amount towards the seller. Is that a correct statement?
As a seller.
No, you will be have to pay more premium to the seller in that case because
Put.
you are actually selling, let's say, or buying it much earlier or closing the contract much earlier than the March 19th.
No, no. So, see, premium is nothing but the price of the option, right?
Right.
So, let's say if you are a buyer of the premium, buyer of an option, and you have paid, let's say $300 at in the beginning, and this bet is started going towards your side. You are winning in this particular bet. What is going to happen? This premium is going to increase. This price of option will inflate further, and when you are closing it, you are going to get that money. So if I show you an example, let me show you an example, guys. Somebody was asking me about closing the contract. So for example, I have already sold these puts. So let's take our example of uh, which one should I take? Which you must be okay. Let's take example of Uber. So I sold a put for Uber, right? So Uber's current price is 58.58, and I have sold a put of $50. So, and I am already making 80% profit here. It's going to expire on Feb 19th. So if I want to close it, I can close it today itself. And if I'll close it today, though my overall option was of $132. So when I sold this particular put, I have I collected $132. Make sense, guys? Already that is there in my account, $132. Now when I'm going to close this $26 I have to pay back to the trading or to the somebody who is going to close this contract for me. So this $26 is now going out of my account. You can see here $26 debit. So I collected $132 as a credit, and now when I'm closing it, I am doing a debit transaction. This is because I am a seller of this.
So this one we can, I am clear on put one. Call options, if we leave that, it will expire. That's it, right? There is no need to do anything in the call option.
You are a buyer of a seller.
Buyer, call, I bought a call,
Mhm.
but the stock price went down. So at the end of the day, my call rate becomes zero. So
Yes,
if I leave it, that's it, right?
yes. I mean, but you are
Okay.
losing that premium, right?
Yeah.
You are
So no
losing.
need of closing or nothing, right?
Yeah, of course. I mean, even a seller need not to do anything in that case. This
Oh,
example,
okay.
right?
Okay.
Everything will happen automatically in that case also.
Oh, okay.
Yeah.
Good.
It's an option for you. It's a choice for you to close it early.
Okay.
Does
Okay.
not mean that you have to do it. But on expiry date, depending on the stock price and your strike, something is going to happen. And
Okay.
that particular something, what is going to happen, will be decided as per these scenarios. So for seller and buyer, once you are in a contract, it's not really required that you have to do an action, but you might do an action if you are losing in some particular case, right?
So what my understanding is, selling the put is always better option, I think, right?
Yes, I recommend to start with selling the put,
Yeah.
especially in this particular market. I have done a lot of selling calls too in the beginning, and I made decent money. But right now, market is very bullish because especially because government is printing money, so you never know how much money is going to come because of this stimulus and so much money which has been printed. So market is going to be bullish for some more time. Market
Okay.
will crash. I think when government will stop printing money, and then you might be good at selling calls.
So then selling the call. Okay, okay.
Yeah, but selling call is actually still more risky in my opinion as compared to selling put.
Then buying put. What about buying put?
Buying put, you are buying an option. You are gambling about a on a particular stock if it is going to go up or down.
No, no. Selling a call is risky, or buying the put is risky.
Everything is risky. You will
No,
have
no.
to.
I understand, but more risk.
No, I think I wouldn't define in this way. Will have to look at it. I mean, that's where this learning journey is there, so that you see everything, because the risk and reward is there in each of these options,
Correct.
in each of these choices. And generally, selling options is generally anyway considered riskier. And what I'm trying to uncover here is that how you can manage your selling side and how you can be winning even in the selling side. But generally, if you read about it, selling side is generally riskier. But yes, at the same time, buyer, you are always betting and you are always paying a premium upfront. So you are always worried about it, and you have to be very, very good at your timing if you have to be a buyer and win that particular bet.
Okay.
Okay, so let's go here. So how to buy stocks cheaper using options. So this is something I wanted to cover today. We have already seen we can sell put um, out of the money, and out of the money means, if I show you in terms of example, let me show you on Robinhood first so that everybody is on the same page. So if we talk about selling put out of the money, it basically means that the strike price will be lower than the current stock price. So bingo, I think a lot of people were playing with bingo. So let's pick up that as an example today. So in my passive income strategy, the whole idea is that if bingo is or any stock is at particular price, we sell the option at a way lower price. So for example, if bingo is at $10.93, we will sell put for $7 strike. So let's say this is a $7 strike. So in this particular example, if I am keeping $7 strike, um, this is $7 strike, I am going to get $10, and that is my passive income here. So and I'm putting a collateral of $700 in Robinhood for that. So let's say example of bingo, strike of $7. So this will become out of the money, $10. So this is more of a passive income strategy where we are way away from the existing price of bingo. Let's say $7 a strike, and we are not expecting that bingo is going to come up to $7. Hence, we are selling a put so that we are going to keep this credit of $10. And if until and unless this price is going to come up to $7, if bingo will come up to $7, then either we will have to take the assignment, which basically or technically means we have to buy bingo at $7, or we will have to pick up a loss over here. So this was more of a passive income strategy where we are very safe and playing very far away from the actual price of the stock. In this particular strategy, we are thinking little differently. In this particular strategy, we want to buy the stock. So for example, we want to buy bingo for sure. Let's say a lot of people are very bullish about bingo and they are expecting that it is going to go to $20 or $25. So in this particular strategy, we want to buy bingo at any cost. So there are two options for us in this, guys. One is definitely want to buy the stock. You want to buy stock for sure. So in that particular case, what we should do is sell put in the money, that is sell put at a strike so that stock gets definitely assigned. How will that happen? If we sell bingo on a higher strike price. Let's say bingo we sell at $13. What does that mean? It means if by February 19th, bingo is below $13, it is going to be assigned to us. We have to take up bingo. We have to buy bingo for $13 as an option seller. Is it clear to you guys, or it is not clear?
It's not clear.
Okay. Okay, so let me try to show you with this example again. This was a put example, right? So when
So
a buyer,
seller of a put actually is more bullish, right? In this case,
seller of a put is generally bullish. The outlook
right?
of a seller of a put is bullish.
Is bullish.
Yes.
So generally, you are
So
saying,
then in
Varun,
that case, when you were giving the example actually for the passive income strategy, right?
Yes.
Why would I do a sell a put in that case? Wouldn't I do a sell a call in that case? Because I'm actually expecting it to go lower,
No, as a sell. No, if you are selling a put, you are bullish, and if
right?
you are selling a call, you are bearish.
That is
And
true. So for the passive income strategy which you were showing, Varun,
yes,
you said basically that we were far away actually from the reality that it's not going to go to $7,
yes,
right? In this case, I'm actually more looking for a bearish strategy, right? I mean, I'm more, my perspective or outlook is bearish, let's say that way, right?
hmm.
So will I do a seller call in this case or sell a put?
No, no.
If you are a
Here we are bullish actually in this selling a call, selling a call, right? For
Selling
selling a
a
call.
call basically is bearish, is what I
mhm,
saw, right?
yes,
So that really mean basically my outlook is that the stock will be worth less.
yes,
And that is what basically we are trying to do in that example of passive income strategy, isn't it?
no.
No, okay. Maybe
So
that's where the confusion is.
yes, and this is something which takes some time to absorb, because selling options have more technicalities in terms of looking at it in this perspective. Buying a call is very easy, right? You buy a call. So let's try to understand this further. Um, so you are a seller of a so bingo is a good example, right, guys? So buyer of a put, buy put bingo for $11. So let's say if you are a buyer of a put for bingo, what do you expect? You were expecting bingo will go down.
Yes,
So sell put, this is a transaction which is happening, makes sense?
right.
So he is expecting go to take it down. So he has to expect that it should not go down. Is it good?
Mm-hmm.
Now, if bingo does not, so in this particular case, this is bearish. So he has to go bullish. Make sense?
Right.
So this is how you will look at it. So once this is there and bingo ka price is $11, if bingo does not go below $7, correct?
Mm-hmm.
A seller of a put is going to keep the premium plus premium, add premium, subtract premium. Make sense?
Mm-hmm.
This passive income strategy is completely focused on earning this premium. That's it.
So if it goes actually, let's say $8 on the day actually when you have to execute the or sorry, you have to close the contract,
Mhm.
right? So in this example, then the person basically the buyer, let's say in this case,
Yes.
would lose the money. Is what you're saying actually, because then he has to bear the loss of that $1 of a difference plus the premium.
Yeah. Buyer of a call is going to lose this premium. Let's say on expiry date, and this is what I have covered in this particular example. Um, in this particular example of call and put. So, but let me cover this. Expiry date, let's say this is Feb 19th. And if this particular price is, let's say $8, makes sense, bingo price.
Mm-hmm.
What will happen? He's going to subtract premium. He's going to make premium. That's it. That is what will happen. If nothing, if nobody does anything, this is what is going to happen on this date, on Feb 19th. If it is $7.1, make sense? This is going to happen. If it is, and let's also define premium here. Make sense?
Mm-hmm.
Making +1, sorry, -1. This is +1. If it is $6.5, what will happen? He's making, losing 0.5, making 0.5.
It's the other way around, right?
No, it
No?
is still,
Okay.
he's still winning. $6.
No, buy will be winning.
Buy will be winning, right? In this case, because your buyer saying that he wants to get it down to $7, it is actually even much more bullish right now, right?
Yes.
Or
He
bearish,
will
I'm
be
sorry.
winning, right?
Yeah, that's what I wanted to bring. Why seller is winning here? Anybody?
Yeah, because it didn't come down below 7. So seller of the put, he is making the money.
Below 7 or below 6?
Below 7.
But 6.5 is below 7.
Okay, because you're
below
saying
6 for the
basically
year.
in this case, because the premium price is actually $1, so it really has to go
Correct.
down less than $6 for a buyer to make the money.
Absolutely. So this is the power of premium selling. Once you get that hang of this particular concept in this way, that once you start thinking this way, you will start calculating your profit losses in a different way. So your break even here is
$6.
exactly. So your break even equals $6. Unless stock goes below $6, a seller is going to make money here.
Understand that.
All right. So our passive income strategy is completely focused on this particular concept.
And Varun, what do you suggest? Selling the put, suppose the strike price is $10. What is the best strike price? Is it less than $10 or above $10?
Yeah, that's what I wanted to cover today. And it depends. I mean, there is no good or bad strike. Only thing what we want to first of all understand what does it incur? What does it mean to have higher or a lower strike? And then what is the perspective you have in your mind? If you have this passive income strategy in your mind, right? That's what you want to focus on. Then you should have a lower strike, which is way beyond the actual price. So for example, bingo is playing at $11, but you have put a strike of $7, which is around how much? I think 30-40% away.
Yeah.
Right. So
lesser risk, right? In this case,
it's a lesser risky, right? Because the strike price is $7, and look at it, your break even is actually way far. Break even is at $6, which is actually further far. So in passive income strategy, you are not playing too very risky game. So while option selling is considered to be a risky proposition, what I'm trying to show you here is that you can remain far away from the market and still make some money. Of course, the money is not too big. You are just making some premium of $1, but it's not too bad.
Yeah.
But because you're not playing within the market, you don't need to monitor it at all, by the way, guys.
Yeah, but safe side.
You are playing safely. So this is your passive income strategy.
Yeah.
So all I was trying to suggest is that we can learn all of these the various tricks, and then according to your risk appetite, you can play it. And risk appetite and your how much capital you have, because option selling is capital intensive for sure. So learn all these things, and then you will say, okay, Varun, this is a stock where I want to be super bullish. Let's take more risk. So, and in this one, you will suggest, okay, let's play it, very, very, very conservatively, because we just want to make passive income here. So every person is different and everybody will do it in a different way. But passive income strategy is something which I definitely vouch for, and I definitely try to do in my own trading style. But does not mean everybody has to follow the same style. But we want to learn all of these tricks. But so in this passive income strategy, the whole idea was that we remained very far from the stock actual price. Make sense, guys? And we keep making this money, this premium. This is a slow money, but this keeps coming in. And if you see most of my stocks here, which are making money, they are all are based on this particular strategy. Like Novavax, it is at $290, guys. Novavax, and my strike is $75. It is giving me $830. Not too bad, right? It's going to come. Money is already there, $830, and my contract will expire in Feb 19th. So this stock has to crash by almost 70%, right, to come to $75 and beat me. Fiverr
It's very safe bet.
Fiverr is giving me $685. Currently it is at $274, and it's paying me $685, and it is at $200. It has to crash by around $15 or 15%. And already I made enough money. I mean, I am 95% profitable here, 98% profitable. I can close it today itself by paying some small amount of money. Apple, $110 strike, $125 strike. 125 is still little aggressive. So all I'm saying is I can be more aggressive. I can be less aggressive about a particular stock. So I think, Keshav, you were asking about Zoom stock, right?
Exactly,
That's right.
exactly.
Now it
Yeah.
depends on your own risk capacity. So let's say you are very, very aggressive about Zoom, so you can play very near strike. But that is not a passive income strategy, because then you have to monitor it. And if stock will go below that on expiry date, you might have to take the assignment. So you should have enough capital. But let's say,
Varun, like we have to pick the stocks which are the value is away from strike price. Is that the
no, pick my recommendation is pick those stocks what you want to keep. You are willing to
okay?
own them. Always play with those stocks which you would like to have them.
Okay.
So that even if it gets assigned to you, you are not bothered. You are always happy about it.
Oh, great.
Okay. And because when after selling put, it gets assigned, and especially when you are playing this passive income strategy and it gets assigned to you, you are the happiest person in the world, because that stock will come to you at the cheapest rate. Make sense?
Yep.
Will it come to you, or you would just basically get the premium and close the contract, right?
You can close the contract, or it will be assigned to you if you are losing it.
Okay, gotcha. So if you're really losing it, that really mean in this particular case is the price is really down in that case.
Yeah. So for example, let's take this example. Let's say bingo comes to $4, right?
Right.
Now, because this is a put, right? And what is my strike? So now he's making $3, which is 7 minus 4. 7 minus 4, but
-1 for the
minus 1.
premium.
Yes. Uh, how much it is? 7 minus 4, $3.
$2.
$2. So he will make $2. He's going to lose $2. This is happening.
So in that scenario, you're saying that instead of losing the money, I can say, okay, do assign actually these stocks to me,
Or take assignment.
because, okay, so then in future, if it goes higher, then I'm actually making more money.
Absolutely, at $7. So this is a choice to you. As a seller of a put, you can decide anything. If you want to lose it, you can lose it by closing the contract, lose $2. by closing the contract, or take assignment at $7 by doing nothing.
So Varun, in this case, right, since the stock price is 4, why would I buy the stock at 7 instead of I'll lose $2 and then get in the market and buy the stock at 4 price?
Yeah, but that is a bet you have gone into, right? This is a whole game you are playing. So somewhere you have
Because
to.
losing $2 is beneficial than losing $3 by buying the $4 stock at $7 price.
Yeah, so it is dependent on you at this particular, on that particular day, whether you are okay to lose $2 by closing the contract, or you want to keep, you may want to buy this particular stock at $7, and later on you just wait for it and sell it again. Like stock will go up and down, right? So you don't want to take a loss of $2. You will just wait for it. After a couple of months, again stock will go up, and then you can sell in the market. So, and that's why I'm saying you should always play this game for those stocks which you want to keep, which you are okay to own, because you know that that stock is going to go up further after in future.
So Varun, you
So,
said basically that this is a passive income that you don't have to actually closely monitor, and the day actually it reaches, whatever the day you have decided, right, for the expiry,
Mhm.
you still need to do something in this case, as you are saying that either you close the contract or take the possession, or if you don't do anything, what happens? Let's say, I mean, it hits the expiry date of Feb 19th. What happens?
In which particular case? Here, in this case?
Yes, so let's say in that case, yeah.
Yeah, if you're a seller of a contract, you will either close this contract by losing some money around, let's keep $2 here. So you will lose $2 on, let's say, Feb 19th by closing the contract explicitly. You will go in the account and you will say, okay, let me show you an example. I'm also losing in a lot of contracts. So for example, um, okay, so in this particular one, I'm losing a lot, right? Which one is the simplest one? Let's see edit, right? So edit is showing me I am losing this money to minus 20.6%. Of course, March 19th is a little far, but if I try to close it today, I'm going to lose money. I'll close this, realize loss of $105. This is what I'm telling you, that if you don't want to take assignment, you can close it early by taking a loss.
But if you don't do anything, Varun, by the date of the contract itself, right? What is the default actually options, or what is the default action which will take place?
If you don't do anything, it will be assigned by doing
It will
nothing.
be okay. So then that's what you're saying basically, that you need to have enough capital, because in this case, then even though it's a passive strategy, you still have to keep an eye on those dates so that you can actually close the contract to make actually the premium, if you are obviously had put those appropriately in terms of being bullish, let's say that way.
Yeah. In this particular example, the green ones, no, in this one you have to do something. You have to do this, not to take an assignment. See, the whole game then happens whether on Feb 19th, you have to take a decision whether you want to take an assignment or not.
Right. So you still have to just be on the look for those dates, because even
Absolutely.
though you are not actually as you said earlier, right, not doing this on a day-to-day basis, but you still have to keep in mind the various dates on which your options are supposed to be, or your contract are supposed to be closed, right?
Yes, of course. I
Okay,
mean,
understand that.
you won't
Understand.
do anything. I mean, you will just every time. I mean, I just look at my phone and see, okay, where is my position, but I don't do anything else. And
Understand that. Understand that.
so for these two green things, I don't need to do anything. I can see, okay, they are green. This one is below strike. So here also I will have to take this decision. Option. By the way, guys, here also we have to take this option. Option. First, take assignment by doing nothing. Second, make $0.5 profit by closing. So there is a decision making here too. though I am making a money here, by the way, as a seller, I am making money, but if I don't do anything, then that particular option is going to those stocks will be assigned to me because it is below strike. So that's a part of the contract, right? And let's say, and is it really, what do you suggest? Is it bad if it gets assigned and you have enough capital? So what do you guys say?
Super. This option is always better.
Right? I mean,
Yeah,
there
it
is
will be
nothing bad
better.
in that also. I mean, both of them are in my winning situation for making me win. If even if it gets assigned to me at $6.5, next day I will go back, and if I want to sell it in the market, I can sell for $6.5, and it's not going to mean anything. So I can make,
So
if I want
what I understood is, Varun, if I want to buy some stock, instead of buying 100 shares, just to sell the put in below price,
yeah. So this
get
was a
the
topic for
premium,
today.
get the premium, and you can, if it comes below, you can buy in the lesser price, right?
Yes, that
Without
was a
tension,
topic.
anything.
Yes, that was a topic for
Got it.
discussion.
Thank you.
Right, guys?
Because so far I bought only calls.
I understand that. I have also done that, and I wanted to at least make you understand this concept of selling side, so that we start taking conscious decision. And buying call is not good, not bad. I mean, if you are highly speculative and you expect that stock will go up, buying
Yeah,
call
yeah,
is a
yeah.
money maker. But if you really do not want to monitor market every day, this is a strategy for those people.
So
Okay.
Varun, in this case, what we are
Yes.
saying that in case
Varun,
of a buy a call or sell a put, those are the two actually situation in which you have to take the action, or let's say the stocks are getting assigned to you in that particular case. If you
Buyer,
don't do
no, buyer
anything,
it not gets assigned.
oh, it always gets assigned to a seller.
Yes,
Okay,
but
okay.
buyer can exercise it. So there are two. So buyer and seller. Buyer has a right to assign, to exercise. Seller has an obligation to take assignment.
So basically, what we are saying that since the seller actually has sold something which he or she did not have in hand, they always have an obligation to take the assignment if they don't make a decision by the date of exercising.
Absolutely.
Got it. Got it. And as a buyer, I always have a choice
Yes,
whether I want to do it or not.
absolutely. This is a perfect answer.
Okay, understand that.
So this buyer will only have exercise this when things are working for him or his or her favor.
Favor.
Make
Got you.
sense?
Right, right.
Now, in this particular case, I'll tell you where buyer can try to exercise it. Buyer can try to exercise in this particular case over here, generally, to keep those stocks. But generally, people who are buyer of the options, they want to make quick money by buying and selling, right? They want to jump onto some other stock to make more money. So they won't exercise it. If they were in the business of exercising it, they would have actually bought the stocks itself, right? But they don't want to take those 100 stocks. They wanted to leverage with that smaller capital and make more money. So that is a psychology of the buyer. So exercising is very rare. For that reason. So this is what is a passive income strategy, where your strike is far, far away. Okay. So what about if I definitely want to buy the stock, right? And for bingo, I can sell a put off which is in the money. That is selling a put which is at a strike which is high, stock gets, so that stock get definitely assigned. So in this particular example, if I want to ensure as a seller that this stock should definitely be assigned to me, what should be my strike, guys? So here my strike was 7, bingo was at 11. What should be my strike so that there is a higher chances of this getting assigned to me?
like around 10.5 or so.
10.5. What about having it 13? Which one will have a higher probability of assignment as a
Yeah,
seller?
yeah, 13 might be more.
Yeah. So 13, the more you're more going in the money,
Okay.
there is a more chances of getting this particular stock assigned to you. And that is the concept I wanted to cover today. So what is going to happen let's say if you are trying to sell bingo and you put a strike of 13, strike price is around 11 right now, and you sell it at 13, what's going to happen? Because bingo is already at $11 and let's say bingo does not move, and let's keep it as $11 here. If bingo is at $11, the buyer so buyer of a put is actually winning in this particular case. Correct me if I'm wrong, right? So this also is little difficult to absorb because I am actually playing above the strike already while I'm a seller, and it is not a winning position for me. But here also we have an opportunity, and that is what I wanted to cover here. So if I am at $13, my strike is at $13, but the bingo is at $11. In this
So that is
particular
out
case,
of the money, right, Varun?
this is
For the
out
selling,
of this is in
13
the money.
is out of the money, right?
13 is out of the money.
Current strike is 11.
You are selling a put. It's
Correct.
not.
Selling the put. Selling the put.
Yeah, you are put side, right? You are thinking from call side.
No, selling the put. I am selling the put.
Yeah.
Current price is 11 and I am selling strike price is 13. Is
Yeah.
it in the money or out the money?
No, it is in the money for.
It's in the money.
Yeah. There is another school of thought where they always think from a seller and a buyer side. So don't get in that particular school of thought. Always think that this is a concept.
Okay.
So buyer of a put and stock is below $40, below that particular price. So what's going to happen? Okay. I mean, for call and buyer, we are trying to put the same name in the money and out of the money. Otherwise, what happens is there is a lot of confusion between buyer and seller. Let's say I am a buyer of an option and you are a seller of an option, and we are talking about in the money, right? And we have a different perspective to it, then it is very difficult to understand. So if we just keep the same baseline for both of them, then we are always talking in the same terms. So that's why let's keep it in the money for a put. So this is in the money for put. So buyer of a put is going to make profit or loss after subtracting premium and seller of a put also getting assigned, take assignment by doing by or make correct. That's what is going to be the option for the seller in this case. Make sense?
Yes.
Okay, so now let's look at our example. What did we do? So bingo sell to open Feb 19th, 13 put, and I'm collecting a credit of $2.68. So if I show you, even in here 13, okay, same, exact same. How do I get rid of this? Guys, do you know? Okay, here it is. So at $13, I am making a credit of $2.68 if I'm a seller. Okay, so let's calculate this. Let me put this here. So for a seller, 13, what will be my break-even price here? If I take a assignment, what is my break-even? 13 minus 2.68. My premium is 2.68. Is it working for you guys? Is it clear? Does that
Yes.
make sense? So my break even here is 13 minus 2.68. Hence 13 minus 2.68 कितना होता है? 13
1034, 32.
1032. Okay, so if I am taking an assignment here, which is highly likely, right? Because this stock is still at $11. If I don't do anything, this is going to happen. This stock will be assigned to me. And what will be the break-even price for me? $10.32. So imagine, guys, stock is at $11 and I have sold in the money put, which generally people see it very risky and it's not the right approach, but still my break-even price is actually lower. So I really wanted to keep that stock because long term I want to have that stock, right? And so that was my tactic about it, behind that. And I'm still able to get that for a cheaper price over here. So once you understand this concept, you will never try to buy stocks right away. You will always try to go in this option market, browse through the options pricing and see where you are having a better break-even pricing. And of course, this is going to happen, make premium profit or loss by closing. So the day when you will close it, if you want to use another option, which is not your intention here, right? If this was your intention, then maybe you should have done this particular strategy, passive income strategy. But generally, if you are doing this kind of strategy, you are willing to take assignment. That should be your thought process.
Varun, I have a question.
Yeah.
Mukesh here.
Yes, Mukesh.
Varun, in this scenario, would you recommend putting an expiry very close, like a week or 2 weeks at the most? Because if you put a long expiry,
Yes.
the assignment may not occur and the stock may go up in the price or down in the price.
Yes, absolutely. You are right. Yeah, because generally, if you want to buy a stock, you want to buy instantly, right? So even in this particular case, it's a good strategy to keep a nearby date. So in this particular case also, I just kept Feb 19th, which is the nearest stock I got, expiry date for this stock I have got.
Thank you.
So this may not be the right strategy to follow this one, right? You can obviously do it, but that is not the intention here. You would want to take assignment, and my focus on this particular class was about how to buy stocks. That's it. You have an intention to buy a stock, how you can do that. So this was one. If you want to go and you definitely want to get the assignment done, then you take a higher strike, and you can expect that, okay, this stock is going to be assigned for sure to you. So this is one way. So because yeah, this is also same price, right? 10.32. Yep. Now, this is one way of doing it, where you definitely want to buy the stock. The other option is that you are very flexible about it and you want to get most advantage of the situation. You are okay not to keep it, or you are, if you get these stocks, you are also okay. If you don't get these stocks, you are also okay with that, right? But you just want to get the maximum benefit out of the situation, right? And which is mostly the case. So you are flexible about it. Then you should sell put at the money. Why? Because at the money gives you the best break-even prices. So if I sell put at 11 itself, and I am a sell put, I am a seller only, and break is it as $11. Let me not keep this. This is confusing now over here. We'll focus on sell put. Again, we have same options. Only thing is here, it is fine actually. 11 minus what is my on 11, what is my money I'm getting? 1.33, right? 11 minus 1.33. What is the amount? Is it the same? 9.67. Okay, so you can see the example just by making it at the money. My break-even price has become further low. And whole intention of showing this thing to you is that you can decide what is your intention behind doing a trade. Correct? You can follow passive income strategy where you are far away from the actual price, or you can do in the money, or you can do at the money. And depending on your strategy, your the things will change, or depending on your intention of on a stock, your profit and loss or your break even will change. So you can see here, while it shows premium to be lesser, right? Generally, if you see here, uh, it is showing 1.33 here, right? But on 13, it was showing 2.9, 2.68. So if you just see that over here, you will see, oh, my premium is actually higher here, 2.68. And my premium here is actually lesser, 1.33, correct? But then if we calculate our break-even pricing here, then you see a major difference that, okay, my break-even is actually better over here, which is 9.67. And that will change your thought process of putting a strike.
But Varun, as actually it goes, in the case of passive strategy as well. So you actually have a date which is far away. I think that's what other person was asking in this case.
Mhm.
So let's say the other, you're gonna cover the other scenarios basically where actually the price literally goes up.
Yeah, if price goes up, then you can't control it anyway. Maybe if you are expecting that it will go above 13 also, then maybe you will put a little bit more strike. The whole intention of yours is to buy the stock, right? And uh, either you have an intention of definitely want to buy the stock. If you definitely want to buy the stock, always go further in the money. Maybe you can put, instead of 13, you can put 15 as a strike price. But your break even price will be a little bit lesser, bit more than this then.
So Varun, I'm still a little confused and I
Yeah,
have
I'm
a
confused
question.
actually in this case.
Yeah.
Yeah.
Yeah. So just a question, Varun. So today the price of bingo is 11.
Yes.
My contract is for Feb 19, right? I'm putting a strike price of 13.
Yes.
So between today and Feb 19, if bingo shoots up to say $15,
Mhm.
okay, my strike price was 13.
Yeah.
So what happens in this scenario?
Yeah. If it
Will I
goes to
still
15,
get, yeah.
yeah, if it goes to 15th or Feb 19th, right?
Mm-hmm.
Then you will get $2.68. Then you are not getting stocks.
Okay, so I'll only get the premium
Yes.
and I won't have any option to buy the stock.
No.
Okay, so the
So
only option I have to buy the stock is on Feb 19th, it is at 13 or below
13th or low.
or low.
sorry, can you come again?
So the only option to buy the bingo stock on my date of Feb 19th is like it is at $13 or below it, and the my buying price would depend on the price on Feb 19th,
Yes.
or it will always be 13 minus the 2.68.
Yes. Uh, so if you want to definitely buy the stock, this 13 is just an example by seeing the bingo's pricing. When I went to
Mm-hmm.
bingo's pricing, um, so I just went into the trend, and that was bingo's highest pricing. So 12.58 is the highest price if I look at it.
Correct.
So
And
13, yeah. So I am just expecting that it will not go above 13, and that's why I put 13 as the strike price. But let's say if you are assuming that it will go 15 and you definitely want to buy that stock, maybe you can put 15 as your strike price.
No, I get that. Means strike price. So if it goes above my strike price was my question, right? Means in that case, I'll only get premium. But say it doesn't even reach 13. From 11, it is only going up till 12.
Yes.
Okay. So in that case, also, I'll have an option to buy with the strike price minus 2.68 or will be 12 minus 2.68.
If it goes to 12, right? If it is at
Mm-hmm.
12 on Feb 19th, this will be your pricing. This will remain constant for you.
Okay.
It won't change because of the
Okay.
stock price.
Okay.
There was one more question, right?
I think one of the question was the same actually in this case. So what we are saying in this case is the sell put in this particular case, the further you go away in a similar situation, how you showed into the passive strategy, you basically making the money only on the premium, but not intend to basically take the position. And you're actually going much aggressive if you really want to buy the share in this case.
Absolutely. This is just about aggressiveness. So in passive income strategy, you are not aggressive about having that stock, right? You
Right.
you're not aggressively looking for the stock. You are just trying to make some money. And if it happens that you fall into that particular place where stock still goes below that, then you accept that particular loss or take the assignment, right? That is your intention when you are in a passive income strategy mode. But here you are aggressively trying to buy that stock. And even I follow even this strategy when I'm very bullish about a stock and I want to remain a seller of a stock. Even in that particular situation, this works for me. So if I show you an example here, mm, so I have done couple of in the money. Okay, this FTOC. So I placed this particular contract, I think 2 or 3 days back. If I show you here, FTOC. Yep. So I placed this particular contract on 4th. Today is what? Today is, I think 8th, right?
7th.
7th, yeah. So last week only I placed this and I mentioned this. This is a very aggressive strike, FTOC. And this is a 15 strike at that time. And FTOC never went in up to 15. So this is already in the money for me if you observe. FTOC, it is showing ITM in the money. This is a selling put, -1 sell put, and this is at $13. But I am very aggressive. But if you observe my credit over here, that is 2.60. So 15 minus 2.6. My break even is at 12.4 on FTOC. So I was willing to buy this stock at $13. But what I did, instead of doing that, I placed a sell put and now it is going to cost me for $12.3.
So Varun, is that the reason it is showing the negative return actually for the FTOC when you're looking actually your gain or loss?
Over here in this one,
Yeah.
yeah, this will become green afterwards. This is of March 19 contract. So the way these options work is they gradually decay. So the pricing will keep decaying gradually, which will keep coming to the seller and keep going away from the buyer. So the people who have been on the buying call side, right, they would have observed that their money keeps reducing. If the stock price does not move, their money will keep reducing day by day, because that option pricing is decaying every day. That is called theta decay. We'll cover that also in one of the class. But every day I am making, this is a theta here, I am making $1.97 every day if stock does not do anything. Almost $2 every day. At the same time, buyer of this particular put, he's losing $2 every day if stock does not move. That is how this concept works. Um, but this will start becoming green. I'm pretty sure about it. If stock does not move from this price, this will become green. It's happening because every time the pricing of the stock is going up and down. And when I place this particular option contract, after that, I think the stock would have gone a bit more down. Hence, it is showing me bit of a negative. but this will come in green soon. Was it confusing or was it okay?
I think a little bit. I mean, as you said, basically that we need to just grasp basically and digest it.
Yeah.
I think it also matters to our appetite also, right? In terms of the various strategy which you are showing right now.
Yes. Yeah, but for now, I think what we should focus on, and because all these concepts we have to cover one by one, and I have to put content around it. But what we should observe here is that I put a very aggressive strike. I am willing to take the assignment of this stock. So FTOC, if I observe, um, yeah, FTOC is trying to acquire Payoneer. So and Payoneer is one of the payment gateway company, and it's quite famous. I think even in India it is famous, and in many other European countries, Payoneer is one of the good payment gateway. So I am bullish about this particular SPAC, and hence I wanted to get the assignment. So instead of buying it, I tried to place this particular options contract on this. So my break even here is 12.4, and if FTOC does not go above 15 on March 19th, then this particular stock will be assigned to me, and I will decide at that time whether I want to take the assignment or I will just come out as a profitable situation. Maybe I'll just do this kind of strategy where I'll just close this option on some $100 or $150 profit. But I just wanted to show you the example that you can also use this strategy to buy stocks. So you can sell put in the money. So you are going far away from the actual price, and so that it gets assigned to you, just like the example I have shown you to you on the Tastyworks. Or you can do sell put at the money, where you can have a better break-even price, but the probability of assignment in this particular scenario is lesser, because it is highly possible that bingo will go above $11. So your probability will be little lesser in this particular case. Hence, you have to be flexible about it. But if it gets assigned to you, your break-even price is going to be the best one, always. If you're selling ATM, your break-even is always going to be best in any case. And sell put OTM, this is for the safe trading and for passive income generation strategy. In this strategy, we typically don't intend to take assignment. But if it happens, as an investor, we should be ready and we should welcome it, because it is still going to work in our favor if we use it properly. All right. So key takeaways, guys, again, options have got a lot of options. We'll keep uncovering these strategies one by one. My intention of this particular session was that people who would want to buy stocks, they have got one more avenue for themselves to buy stocks cheaper. So in this example itself, let's say bingo is at $11, but if you want to buy bingo on a lower price, you can actually buy bingo at even $9.67. But of course, there is a pro and con of each and every strategy. So you should have that particular understanding. So it is possible to buy stocks cheaper by using options assignment tactically. So we are putting a tactic around it. We understand that this is how this process works, and then we are using that particular tactic to buy stocks in this particular situation.
But like people who are starting with like initially with smaller capital, it doesn't suit, right?
If
Because
you're buying stocks, if you are anyway planning to buy stocks, yeah, you have to buy stocks in lot of 100.
hundreds, right? Because like with less initial capital, you may not be affordable to buy
Yes.
lots of stocks.
Yeah. You need to always buy stocks in a lot of 100. It won't happen that you will have 50 or 5 or 10 stocks. So you will have to always keep in mind that always stocks are going to be assigned in a lot of 100. So sell put in the money can give us the best premium. So as we have seen in this case, if you see, the premium is $2.68 here, and in this case it is $1.33. So if you just see from a layman perspective, you will say, okay, this is giving me higher premium, so let me put this particular option. But if we go in a break-even pricing mode, then we see the break-even here is more, and here it is lesser. Correct? So that I wanted to cover these two examples here for this particular reason. So sell put in the money can give us a best premium, as we also saw in the example, but has a bit higher break-even price. But and also chances of assignment is higher in this case because we are going far away from the actual pricing and in the money. So you can have better chances of assignment if you are a seller of a put. And if
So Varun, just sorry to interrupt. Just so in the case of in the money, right? We have higher premium and chances of assignment are higher. So consider I don't want the stocks to be assigned. I just want to take the premium and get out of the stock.
yes,
Is that a possibility?
absolutely, it is a possibility if you want to be profitable, right?
Mm-hmm.
It is a possibility if that stock is still above your break-even price. It is definitely a possibility.
Okay, but if it goes up, say to 14, then I don't have that option. Means I cannot buy it, but I'll only get the premium. But when it stays below 13 or say comes around 13, do I still have the option to take the premium instead of purchasing the shares?
Yeah, below 13 also. Let's say in this is a scenario you are talking about, right? Uh,
Yeah,
let's say this is a 13. So our break even is 10.32. So on
yeah.
tab 19, let's say if stock is still at $11, you're going to make some profit.
Mm-hmm. Yeah. But if I purchase, it is still at 11. I don't want to purchase even if it is at 11.
Yeah, it is
So
still
do I have the option to take 2.68 and get out?
not 2.68, but you will get some premium. You will still be green and you can close the contract early without
Oh,
getting.
okay. So it will not be 2.68, but it will be something less.
Yeah, it will be little lesser, but you will be able to close it. For example, as I showed you here, right? Let me see if I have got some. See this AQB, right? This is in the
Mm-hmm.
money. This is still in
Mm-hmm.
the money, right? This stock is at 9.58. My strike is 10. So it is already running
Yeah.
lesser than that, but this is green already for me. And I might have more examples like that. Um, but yeah, as if I'll go further in this particular time frame, on Monday maybe it will become 10% or something like that, depending on stock pricing. But you can easily see here that my stock price is 9.58, but my strike is more than that, and this is already green. So if I close it today, it's going to make me $8.5. Make sense?
Okay, I'm a little confused.
It's the same example, right? What you were asking for. Um, that
So
strike.
in this case, I'm just getting the premium, right? I'll just close the contract and get the premium, or
Yes, I will close the contract and I'll make the premium. So if I close this now,
and even though, yeah.
if I close this, so this is the money, and I have to pay for this closing, but it's showing me profit.
So is that premium down from your earlier value, or it is still the same premium in this case?
No,
2.13.
I have got collected 2.21, $221 I
Okay.
collected already. Now to close
Mm-hmm.
this contract, I have to pay $213.
Okay, so you have to pay $213. So effectively, you are getting $8 per share,
Yes,
or only $8
per contract.
per contract. Okay.
Yes. So I have already collected 2.21 or $221. That is there
Mm-hmm.
in my account. Now, if I
Yeah.
want to close this contract, I don't want to take the assignment for
Mm-hmm.
AQB. I can close it
Mm-hmm.
and to give away my $213, which I collected in the premium, and make just $8 profit.
Okay.
And similar
Okay.
transaction you are going to do. Let's say if in this particular case, uh, uh, let's say price of the stock is at $11, right? It will follow the similar example for you. So on that day when you are closing it, you have to give some money, but you will still come out profitable, just like this case.
Varun, can we decide before whether we have to take the stock or uh, get the premium before date? So like we can plan it like that.
Yeah, you can close the contract and collect that premium. Let's say if you are green in any of these trades, right?
Okay.
So you are already green in this. So and you say, okay, but I don't want to get in this particular contract further. Let me close it. So I can go ahead and just close it.
close it on March 19th. I want to do like that, something like that. On March 19th, either take stock or close it on
Yeah,
March 19th.
yeah, you can do any time. You can come on
Okay.
March 19th as well, and then you can close it. But does not mean that it's going to remain red and green always. So depending on your stock price, it will keep becoming, red or green. But right now I'm just showing you an example where my strike is still actually in the money. It is still higher than that, so it has a risk of assignment. So it can be assigned to me, but I am actually profitable in closing. So you can close it anytime until March 19th, any day you can close it. But if you don't do anything, and this is the status of this particular trade on March 19th, this AQB stock is going to be assigned to you since you are selling this option if you don't do anything. And this is a status because you are playing with an in the money option as a seller, so it will be assigned to you. Maybe so it will take some time for you to absorb it, but once you start placing these contracts, then you will start easily getting it. But as you see, in this example, I am making it, it is already profitable for me. I mean, March 19th is still 40 days away, but I am already making $8.5. If this stock does not move, this green will keep going up for me. So I am hoping that it might make me around 50 to 60% profit, and then I'll exit this, irrespective of whatever happens here for this stock price. But once you will start placing such orders, then you will start observing that how these things are happening. But this is an example of that. So sell put in the money can give you higher premium, but your break even is going to be a bit higher, or it won't be the best. If you are at the money, you are selling it exactly at the money where the price is, your break even is going to be the best. But the chances of assignment is obviously 50%. But still, mostly people will prefer this because you are getting, best break even pricing here if it gets assigned. Uh, you have to buy stocks in a lot of hundred. So anytime if you are using options for buying stocks, you have to be prepared to buy stocks in a lot of hundred. So for example, Keshav, you were asking for Zoom. If you are buying Zoom, then you have to buy in multiples of that 100. It's not a good strategy for a day traders and short-term stocks where you want to enter and exit. The movements are very fast, or you are speculating about a stock. Then I don't think it's a good strategy for those. And main reason is because your expiry dates might be a little bit away, so you may not be able to get enough benefit of it. So that is a reason behind not having it as a good strategy. You have to wait until the expiry date to get this assignment done. Any question, guys?
Well, it might be stupid, but I'm just going to ask that actually anyway.
Mhm.
If I do this actually, and although I don't have a physical possession of the stock, considering that I'm actually having a better outlook in this particular case, can I put basically the sell put, and at the same time, uh, I think that the reverse of that option basically to get the money basically in a bullish market? Is there a possibility for that?
So what kind of trade you are thinking of? Give me an example.
So like a sell put basically for you is that you have an opportunity to buy it lesser than the market price when the stock actually is going up,
Mm-hmm.
right? Now you said basically this is not good for the day traders or the short term stocks, right? Because obviously you will not get the physical possession of the stock till the date till the day of execution happens, right?
Correct.
Whatever the date actually it is.
Mm-hmm.
Now at the same time, let's say I put something on the bingo, I put a sell put to get actually a stock for the lesser price,
Mm-hmm.
right?
Yes.
And would there be any other option basically that I can also place to sell it, let's say that way in this particular case at the same time, so that my transaction basically can happen within themselves rather than I actually taking the possession or waiting for it?
So you are what you are trying to close a contract, is it? So
I mean, if I
what?
close the contract, I would not take the possession, right? Is that
Correct.
correct?
Yes.
Right?
Yeah. Contract is closed, then it is done deal. I mean, there is nothing.
Nothing you can do. So basically, what you're saying that this is only possibility in this case to do this kind of a strategy is for those stocks which probably have a better outlook in future, and you know that horizon basically, and before that you want to buy it on the lesser than the market price.
Right, that's the idea.
Okay.
I think that's where you would want to use this strategy of buying stocks through use options. Because if a stock is anyway moving up and down too much in a day, then you might be losing in this particular case or maybe winning in this case. So for example, let's say AMD, right? AMD could be a very good example. Like a lot of people would want to buy it. So if we go with AMD, or let me say Apple. Apple could be a good one. So let's say Apple is at $136 and you want to buy it, correct? So you want to buy it at $136 or lesser. So, and this is a good stock, you would want to always keep it, right? So if you buy it on Feb 12th, so for example, this has got Feb 12th as well as the expiry date. So you can buy it for, let's say $138, correct? So you put a strike of $138. I'm just giving an example, assuming that it is going to assign to you 138 minus 2.56. It will be around 135.5 for you. So you have already you have saved $1 right away on Apple. Of course, you have to buy 100 stocks, but it is at 136.68 and you have got pricing of around 135.5. And Apple is a good stock to keep, right? You anyway wanted to buy it and you will be able to get it in on Feb 12th. And you want to be more aggressive about it, maybe you can put 145, correct? So 145, let's say by Feb 12th, it will not go by that time. So 145 minus 8.4, 145 minus 8.4. Okay, so this is giving you almost similar pricing, 1.6.60. So only 0.8 cents per stock. Only that is your help here. But if you go a little bit further, then maybe you will get better. 143 minus 0.6.
I think further you go, you probably would be actually buying on the higher price.
Yeah, not higher price, but yeah, you will not get too much benefit.
Right, right, right.
So always when you are putting this particular stock for this particular strategy, whenever you are placing the order, you would want to calculate it, that what's your break-even price coming up. And guess what, guys? This is called extrinsic and intrinsic value. and uh, and maybe I'll cover that also in another session. But how much money you are collecting as a part of options value, that is called extrinsic value, and the money which is a difference between actual price of the stock versus the strike price, that is called intrinsic value. Maybe I'll cover that also in another video, but I didn't want to put too many concepts here. Only thing which I wanted to bring as part of this perspective is that this is also possible for you in options.
Got it.
Anything else, guys? So anybody has any question about the trades which I have placed last week or Vaishali placed?
Varun, did you make any money on that VUXR for 1 day expiry?
Oh yeah, UVXY.
Yeah.
I have made a lot of money in that. Okay, so in UVXY, I don't know where can I see that in Tastyworks. Here it is it's not shown because now it is showing me I still have a lot of contracts on UVXY. So $798 are further I have to make on this. So the way UVXY works is UVXY is a volatility ETF, just like VIX.
Mm-hmm.
And when market goes down, your volatility goes up. All right. And what I have observed is UVXY does not go below 10. every time it goes near to 10, it shoots up.
Okay.
At least there has to be some volatility in the market to have buyers and sellers, right? Otherwise, if nothing is volatile, everybody is very happy, then trades will not be that exciting. So there is a market cycle which will go up and down. So volatility will be there, and it has UVXY has not gone below 10 until now. It can go below 10, but it's a very rare possibility. And if it goes below 10, I'm happy to take the assignment and wait for a day when market
up.
is highly volatile.
Yeah.
So so what I did on Friday, I sold. This was the one.
No.
No,
You
not this.
got 7 cents or something
Yeah,
premium.
this is the one. On Friday, I placed a bet for Friday expiry,
Mm-hmm.
and I got $6 per contract.
Right.
So,
Right.
so really bad deal in terms of if you see the money, I was making $6 on per $1,000, but I had some money in my account and I was willing to just put it for one day. Worst case, what will happen? It will be assigned to me, and on Monday or Tuesday, some volatility will be there, and I'll be able to sell it. So that was my intention. So I sold 10 contracts. So it was like $10,000. If I show you by calculation,
So you got $60, I think.
yeah. So UVXY strike was $10. Contracts I did 10. So total underlying value was 10 multiplied by 10 multiplied by 100 share each. Okay, 100 contracts each, 100 shares in each contract. So I was giving $10,000. This has an underlying value of $10,000, and I was making $6 per contract per share, 6 cents per share. So around $60 for 10,000. But it was like a Chipotle dinner. So,
Actually, I wanted to put that order, but by the time I saw it was like 2 cents only, I thought it's not even going to give me the my brokerage fees.
okay.
So
It was only when if you have some money in your account and you know that all right,
right.
there is nothing else I am doing today, so why not just make some $20-30? That's it. But yeah,
Are you going to cover covered calls in one of the sessions?
Yes.
Covered calls?
yes, that will be my next session, I would say.
Okay.
Yeah.
Yeah, thanks, Varun. It was very, very informative.
Yeah, thank you. So yeah, this was just for one day. So I opened this in morning, and by evening it made me $60. That's it. And worst case, it will be assigned, and I'll sell it on Monday. And that's I have done this many times earlier. I don't do it often. It was just for the fun. I was doing it since I had some money in my account. But yeah, this is also one way people make money, where they put a trade on Thursday or Friday. Friday anyway it gets expired, and then Monday they are back for trading.
This UVXY has a weekly expiry or?
It has got weekly expiry.
Okay.
UVXY, let me see if it has got daily expiry or weekly expiry. UVXY, I think it has got weekly expiry. Yes, it has got weekly.
Yeah.
So this was one good trade. Any other question on any other trade? On NVIDIA, I placed a iron condor. Maybe in some other class, I'll cover iron condors and verticals. So everybody is also able to place those kind of trades. So right now I'm putting a lot of sell put. So sell put need more margin or more cash to execute. But the advantage is that you can take such kind of assignments here. Like if you are losing side, then you are always you can always take the assignment and then sell it later. So that is an advantage of selling put. But if you don't have enough cash in your account, then there are other strategies what we can follow. So for example, I placed this NVIDIA trade, and I'm making around $4.40, which is $440, and I just need $1,000 for this contract. And I don't think even $1,000. I think I just need $500 or so to execute NVIDIA contract. While NVIDIA is the stock price itself of NVIDIA is $620. So this is iron condor strategy. So it might need just one session for itself to understand this. All right. Yeah. So I think there are few folks here who are not the premium member. So you're free to join the premium membership. Uh, as part of premium membership, mainly I am focusing on sending you the real-time alerts. I am sending it, and Vaishali, Jyoti, they are also sending their trades in real time. And hopefully we are going to get more experts in future. So everybody has their own style of trading, and they are sharing their trades in the premium account. Um, and if you are a beginner and you are a premium member, maybe and you need some help, we can always screen share and validate the trade before you place, so that you get enough confidence. And yeah, of course, we are also having free weekly sessions for the members. So that will be the advantage. So yeah, that's it, guys. So let our money work hard for us rather than we working hard to make money. That is the whole idea of this particular community. So let me know if you have any questions or you have any feedback. Please feel free to let me know on Discord or any other channel. Yeah. All right. Thank you, everyone.
Thank you, Varun. Appreciate that, man.
Thank you.
Thanks for the session.
Thanks, sir.